Picture this. You're sitting in a mahogany panel conference room on the 47th floor of the Manhattan skyscraper. Around the table are representatives from families worth $2 billion, $5 billion, even $15 billion. They're reviewing real estate deals, and something shocking happens. Deal after deal promising 15, 18, even 22% returns gets rejected without hesitation. Then they approve a boring apartment complex in Ohio, projecting just 7% returns. And the room erupts in satisfied nods. Wait, what? While you're grinding to find that next 12% cash on cash deal, these billionaire families are deliberately choosing lower returns. But here's the thing. Over the past 20 years, they're absolutely destroyed the returns of almost every individual real estate investor. It's not even close. So this raises a mind-bending question. How do you make more money by targeting lower returns? The answer reveals a wealth building strategy so powerful that once you understand it, you'll never look at real estate investing the same way again. Family offices, the private investment firms of ultra wealthy families, control over $50 billion in US real estate. That's more than most REITs, more than most pension funds, and more than the entire real estate markets in some states. And they built this empire using principles that seem to contradict everything the real estate gurus teach. Take the Pritzker family office, for example. While individual investors were chasing Miami condos and Las Vegas flips during the 2000s boom, they were quietly buying boring industrial properties in the Midwest. And when the crash hit, guess who emerged stronger? The families who prioritize wealth preservation over wealth creation. And here's what most investors never realize: is a fundamental difference between getting rich and staying rich. And most real estate education focuses on the first part, how to achieve high returns quickly, but family offices have mastered the second part, how to compound wealth over generations without losing it. Let me show you some math that will flip your worldview upside down. Investor A targets 15% annual returns with moderate risk. Investor B targets 8% annual returns with low risk. Over 10 years, who comes out ahead? Your gut says Investor A, right? But here's what actually happens in the real world. Investor A hits their 15% target 6 out of 10 years, but in years 7 and 9, they lose 25% and 15% respectively due to market downturns, over leveraging, or bad bets. Their actual compound annual return, about 6.2%. Now, Investor B hits their 8% target 9 out of 10 years, with just 1 year showing a 2% loss. Their compound annual return, 7.4. Lower risk, higher actual returns, and they sleep better at night. This is why Warren Buffett famously said, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. See, family offices have built this principle into their DNA. Here's where most real estate investors commit financial suicide without realizing it. They put 80 to 90% of their portfolio into value-add deals, properties required significant improvements, repositioning, or management-intensive strategies. They're essentially running a full-time construction and property management business while calling it passive real estate investing. See, family offices laugh at this approach. Their typical allocation, 40% core, 30% core plus, 20% value-add, and just 10% opportunistic. So let me translate that into English. Core properties are the boring, stabilized assets in prime markets with long-term leases to credit tenants. Think a 20-year-old apartment complex in Dallas with 95% occupancy and tenants earning $75,000 annually. These properties generate a steady 6 to 7% returns with minimal headaches. Core Plus adds slightly more risk for 8 to 9% returns. Maybe that same apartment complex needs minor improvements or has some lease renewals coming up. Still manageable, still predictable. Value add is where they get creative for 10 to 12% returns. Major renovations, repositioning, or operational improvements. But notice, it's only 20% of their portfolio. They're not betting the farm on their ability to execute complex business plans, opportunistic investments, or their moonshots, distressed assets, development projects, contrarian market bets, targeting 15% returns. But if it's just 10% return, these fail completely, then 90% keeps generating steady returns. While individual investors diversify by buying properties in 2 or 3 markets, family offices diversify across dozens of dimensions you probably never even considered. They diversify by tenant credit quality, lease terms, market fundamentals, economic cycle sensitivity, and even political risk. But here's the sophistication that separates billionaires from everyone else. They diversify by recession performance. You see, some properties thrive during economic expansion, but struggle in downturns. Others hold value during recessions, but lag during growth periods. A truly sophisticated portfolio performs reasonably well regardless of economic conditions. So consider this. During the 2008 financial crisis, while individual investors were losing property to foreclosure, Family offices were actually increasing their real estate allocations. They had maintained dry powder, cash reserves specifically earmarked for distressed opportunities. When everyone else was forced sellers, they became selective buyers. And here's a secret that will frustrate you. Family offices see better deals than you'll ever find on LoopNet or Bigger Pockets. Not because they have more money, but because they spent decades building relationship networks that generate off-market opportunities. You see, the best deals never hit the market. They get traded between family offices, institutional partners, and developers who've worked together for years. A family office might learn about a portfolio sale 6 months before it's officially marketed, giving them time to conduct due diligence and negotiate, while others are still unaware the properties are available. But here's what you can replicate. They invest heavily in relationship building, long before they need it. They attend industry conferences not to learn. They already know the fundamentals, but to maintain relationships. They participate in real estate organizations, they sponsor events, and create value for their network even when they're not actually investing. The principle applies regardless of your net worth. See, the broker who brings you the best deals, the contractor who prioritizes your projects, the lender who offers the best terms, these relationships were built over years, not when you need them for your next deal. While most investors focus on acquisition, family offices obsess over operations. They don't just buy properties and hope for appreciation. They have sophisticated asset management systems, tracking dozens of metrics beyond financial performance: tenant satisfaction, maintenance efficiency, energy usage, market positioning relative to competitors. Every property has an annual business plan with specific goals and action items. Property management isn't outsourced and forgotten. It's treated as a core competency with clear performance standards and regular reporting requirements. Here's why this matters. Bad management can destroy value faster than good acquisitions can create it. A property generating 8% returns can quickly drop to 4% with poor management. But excellent management can boost a 6% profit to a 9% returns through operational improvements alone. This is where family offices demonstrate true sophistication. They're not just thinking about depreciation and cost segregation studies. They're using structures like Delaware Statutory Trust, EST, opportunity zone investments, conservation easements, and installment sales agreements. Here's the key insight. They understand the difference between tax deferral and tax elimination. See, most investors use the 1031 exchanges to defer taxes. Family offices use them as portfolio management tools to reallocate capital between markets and property types while deferring taxes. They might exchange out of a mature market and into a growth market, or out of a retail into multifamily, all while deferring capital gains. Each exchange serves dual purposes: tax efficiency and strategic repositioning. Family offices start planning their exit before they buy the property. Every acquisition has multiple exit scenarios: modeled out, hold for cash flow, sell for repositioning, refinance for capital recycling, or transfer to future generations. They're not emotional about properties, they're analytical about when and how to exit for maximum benefit. The sophisticated part, they model different exit scenarios based on different market conditions and family circumstances. They might plan a 7-year hold with refinancing if markets stay strong, but have a 15-year hold strategy if market weakens. This flexibility allows them to adapt to changing conditions without being forced into poor timing decisions. Here's where family offices show the most discipline. They use debt as a tool, not a crutch. Typical leverage ranges from 50 to 70% loan to value, depending on property type and market conditions. They really max out their borrowing capacity because they want financial flexibility for opportunities and unexpected challenges. Compare this to investors who often leverage to the maximum, 90 to 95%, even 100% financing. When markets turn or properties underperform, high leverage amplifies losses and eliminates options. Family offices sacrifice maximum returns for financial resilience. They also diversify their debt sources: bank financing, agency debt, private lending. This gives them options when refinancing and reduces concentration risk with any single lender. When one lending source tightens, they have alternatives. Family offices don't try to call market tops and bottoms. Instead, they understand where they are in the cycle and position accordingly. They track down dozens of leading indicators: construction permits, employment trends, demographic shifts, credit availability, cap rate movements, transaction volumes. During expansion phases, they focus on growth markets and value-add opportunities. During peak periods, they reduce risk by selling opportunistic investments investments and focusing on core holdings. During recession periods, they deploy dry powder into distressed opportunities. During recovery phases, they increase leverage and pursue development projects. The key insight, they're always positioned for the next phase, not trying to maximize returns in the current phase. This means leaving money on the table during good times, but avoiding major losses during the bad times. Family offices view technology as a competitive advantage, not a cost center. So they use sophisticated underwriting software, property management platforms, and portfolio tracking systems. They're early adopters of PropTech solutions that improve operational efficiency or tenant experience. Now, this isn't about having the latest gadgets. It's about systemizing decision-making in operation. Better systems lead to better decisions, which compound over time into superior return. The fundamental difference between family office thinking and retail investor thinking comes down to time horizon and risk management. Most individual investors think about their next deal, their next flip, their next cash flow bump. Family offices think in generational terms, building wealth that will last 50 to 100 years. This changes everything about how they approach real estate. Instead of chasing maximum returns, they chase maximum risk-adjusted returns over long periods. They're willing to accept lower cash-on-cash returns for more predictable, sustainable growth with less downside risk. You don't need billions to think like a billionaire. You can apply these principles regardless of your current capital phase. Start with a clear investment criteria and stick to them. Build relationships before you need them. Focus on operational excellence and value creation, not just acquisition. Think about taxes and exit strategies before you buy, not after you sell. Most importantly, adopt a long-term mindset that prioritizes wealth preservation and steady growth over short-term gains. This doesn't mean always accepting lower returns. It means pursuing higher quality returns that are more sustainable and less risky. Diversify across property types, markets, and economic cycle sensitivity. Maintain adequate liquidity for opportunities and challenges. Use conservative leverage that preserves flexibility. Track operational metrics beyond financial performance. Here's what the real estate education industry won't tell you. Chasing high returns often leads to lower actual returns due to increased risk, management intensity, and occasional large losses. The 15% IRR projection becomes 8% reality when you factor in vacancy, cost overruns, market timing mistakes, and deals that just won't work out. Family offices have leaned that consistent 7% returns compound more wealth than volatile returns averaging 10% with occasional large losses. The math of compounding heavily favors consistency over volatility. The ultimate goal isn't just building wealth, it's building wealth that lasts generations. This requires processes, systems, and thinking that transcend individual deals or market cycles. Family offices document their investment process, maintain institutional knowledge, and create governance structures that ensure consistency across decades. They build real estate portfolios that generate income for children and grandchildren who haven't even been born yet. And the reason family offices beat individual investors isn't superior deal flow. Although that helps, it's not access to capital. Although that helps too, it's by having better system, processes, and thinking that lead to superior long-term results. They've eliminated the behavioral mistakes that destroy wealth. These are emotional decision-making, overconfidence, recency bias, and herd mentality. They've institutionalized discipline, patience, and long-term thinking. When you can think like a $50 billion family office, you start making decisions that compound wealth over decades instead of chasing short-term returns. You build real estate portfolios that generate lasting wealth, not just temporary cash flow. The billionaire families didn't get rich by accident, and they don't stay rich by luck. They have systemic approaches to building and preserving wealth that anyone can learn and apply. So if you master these principles, you'll never look at real estate investing the same way again. The choice is yours. Keep chasing the next hot deal or start building generational wealth using the strategies that have worked for the world's wealthiest families for decades. The math doesn't lie, and the results speak for themselves.